Good afternoon, ladies and gentlemen. The market refuses to go beyond 26,300 on the Nifty and beyond 60,000 on the Bank Nifty. Of course, these are fresh record highs, new peaks that the market has traveled up to post a stunning set of GDP numbers. But we've often seen that 26,300 is acting as a major resistance for the Nifty, even though banks are in top shape. To discuss this and a lot more where the markets are headed, ladies and gentlemen, we are now joined by Mr. Vaibhav Sanghavi, CEO of ASK Hedge Solutions. Remember, ASK was one of the earliest movers in the world of PMS before the name even became popular, and they have a lion's share of the PMS market with many schemes, and Hedge Solutions is one of the products that they offer for long-term wealth creation. Vaibhav ji, namaskar, a very warm welcome to you. As always, it's such a pleasure to welcome old friends and listen to their very solid and calm views about the market. Now, analyze for us the sentiment on Dalal Street at this moment, Vaibhav ji. 26,300 refuses to go, even as banks, both private and public sector, outperform the broader index. What is your view on the market at this point of time?
First of all, it's always great to be on your show, as always. Now, when we talk about markets, and you spoke about saying that 26,300 is kind of looking to be a very important resistance. Let me put things a little bit in perspective, where my sense is basically 26,300 probably is just a number. Over a period of time, it has to go above that. When does it happen? Probably in a month's time, 3 months' time, we don't know. But I think eventually it has to do, purely because as we sit and see things, one thing which has got a little us a little more constructive and positive is the revival of earnings. But I say that is basically after 4 quarters. This is the first quarter where we've seen some marginal upgrades in the earnings. At the same time, the corporate commentary in the con calls have been pretty robust, and I do expect that the second half would be much better than the first half. Now, if that is the case, and in FY27, if we are likely to increase the earnings by about say 15%, overall, it's just a matter of time when we break that 26,300 kind of number. Of course, the pace will depend, and it will all depend on how quickly the FPI also kind of come in about here.
Okay, fair point. Vaibhav ji, according to you and your peer group, what is the most critical element that is missing for the Nifty for it to move above 26,500? See, we have everything. Very strong retail participation, corporate rate cuts, GST rate cuts, income tax cuts, tax cuts on the interest rates. But the market refuses to move. I am sure there is something critically absent which you can put a finger on. What could that be?
Yeah, of course, you're bang on, right? We have all the ingredients which are there to see to that robust rally can happen probably in the 12 to 24 months going ahead. Now, of course, in the shorter term, we are seeing some amount of volatility in INR, and because of which we are seeing some amount of sentiment kind of taking backseat. But at the same time, more importantly, I think the participation of FPIs in India is something which we are not seeing in a very convincing manner.
Okay.
I think the they kind of come about is when the pace of recovery which I spoke about is likely to happen at a much rapid pace. Now, there are several reasons, to be very honest, why the FPIs have not come, to be very honest, over the last 3 to 4 years actually, right? And what is it that it is likely to change going forward? So there are a lot of variables around it, and probably we can discuss it ahead as well. But FPI participation is something which is very crucial.
But The rupee is at a record low. There is strong trajectory in Q3, Q2, as you mentioned. This could be a good time for the foreign institutional investors to come in, but yet regularly we see selling pressure. What could be the reason that's preventing them to come to India?
So I would say two or three things, Mr. Patnagar. I think the way, I mean, if you see post FI 21 or 21, 21, 22, when the Fed started to move up in terms of the rates. Now, post that, you've seen consistent kind of outflows coming from an FPI perspective. And to be very honest, that's a direct correlation. When you have seen in history as well, whenever the rates go up, you will see generally the investors pulling out money from the riskier asset bets, which is in some ways emerging markets for them is a little riskier asset. So you saw a good amount of outflows happening to that. Post that, I think because of our valuations, because of our earnings growth trajectory, and lastly, when an FPI investor is looking towards India, they are concerned with the net returns. And when we talk about net returns, they consider net returns after tax. The tax, which is probably on them, in terms of long term and a short term. Honestly, not many of those countries globally kind of do attract those kind of taxes for a global investor. So when you then calculate all of these things and try to calculate your rate of return or expected rate of return, is where you say, okay, there are compelling other opportunities as well. And this actually got augmented or amplified, I would say, because of the internet AI opportunity, which was available in China, Taiwan, and Korea. So good amount of allocation from India actually shifted towards these countries, and wherein we at some point in time were at a premium to the emerging market allocations, while now are at a discount to those emerging market allocations, which is underweight the emerging market allocations. So that's the shift which has happened. Let's see how it kind of pans out. But my sense is the earnings recovery at least should give you a positive spin in the thought process.
Okay. Now that the macro is settled, let us look at what your thought process is at this point of time against the backdrop of very strong tailwinds and good quarterly numbers in Q3. What is your research team or your quant team throwing up in terms of sectors of strength where fresh money can go in?
See, when we look at the earnings recovery kind of happening, this time around, what we do feel is that over the next 12 to 24 months, the earnings recovery would be led by few sectors, primarily from consumption perspective, where we are already seeing some very robust monthly sales number in terms of autos, both two-wheelers, four-wheelers, PVs, tractors, and seeds. So across the board, you're seeing some good size demand coming about from there. So our sense is basically this is likely to continue. There is earnings momentum likely to be there going forward. In addition to that, we do think that the industrials will continue to do well purely because there is the first signs of private capex now kind of coming about back as well, which we've seen in the previous quarter commentary from various corporates. And lastly, I think banking is a sector, especially on the private bank side. They have been a gross underperformer for last 1.5 years purely because due to various reasons in terms of consolidation and due to pressures on your net interest margins. We believe that we should be close to bottoming out on net interest margins. And if the credit growth starts to look up from here, then banking, especially the private banks, may look good over the next 12 to 24 months as well. So all of these sectors are something which we do like, from a longer term perspective.
Okay. Which have been the disappointments to you in Q3, where you thought, maybe macro tailwinds were positive, yet the sector refused to sort of look up?
Well, to some extent, if I can kind of, just being a devil's advocate on the earnings story as well. One, that we do believe that it was a broad-based recovery, but in any case, to find something, which was suboptimal was actually the consumer staples piece, where what had happened is basically there was some amount of inventory kind of correction within the system, and which is where you saw, the results or the quarterly numbers a little suboptimal, in that sense. Of course, we will be waiting for this quarter to see how the numbers are panning out, and probably if it goes well, then consumer staples also becomes, a pretty good story, from a medium to long term perspective.
Okay. Uh, Vaibhavji, at this point of time, what is your view on the rupee? Perhaps one reason why this issue in the market is that a weak rupee always presents a fresh high in the market. Are we headed much lower as far as the rupee is concerned? What could be the trigger for the rupee to appreciate?
See, I think rupee to appreciate, I think, in my view, will probably take some time. What I would do think is basically if you see a average annual rate of depreciation has been close to about 3.5% in that sense. But is following that, this time around, in a very short period of time, we have depreciated, and which means that post this depreciation, we may see a kind of period of consolidation on rupee for an elongated period of time as well. But having said that, I think when we try to, make sense of the fundamental aspects of why the rupee is weaker, of course, one of the biggest reason is because we have an import bill which is pretty, consistent in sense, and including gold, oil, all of these things are at this point in time, kind of not replaceable in that sense. So incrementally keep working on the import replacement story from an economic standpoint. At the same time, capital flows which have been absent virtually, from overall perspective, I think, that needs to be kind of corrected in some sense. We always have this, thing that once we see some amount of weakness in the rupees, when we scamper to see what can be done about it. Probably, I think this is a time when, if we are looking to 2047 for being a very well developed country, then one thing is for sure that we are going to need capital, whether it is foreign or domestic. So whatever it makes, or whatever it takes to get that foreign capital, I think we should, do that. Last but not least, I think at least we should be at par with the other countries as well. So I would say we have several measures to take, both on the import replacement at the same time on capital flows as well, which needs to be kind of taken to correct the whole equation.
Vaibhavji, in the funds that you oversee, which is the largest allocation of capital to in the mid cap space in terms of stocks?
See, to be very honest, we do not kind of take much of a bet on the mid cap and the small caps purely because we are a long short fund, and our primary focus generally is in the top 200 names in any case. So honestly, we do not venture in those lines. But one thing I can say that from a mid cap and a small cap valuations perspective, my sense is I think there is still some amount of time where we need to spend in terms of the growth catching up to the valuations. So on an overall basis at this point in time, we do think that large cap provides you a much better opportunity on a risk reward perspective, and that's a segment to be kind of looked at as well.
I think that's a fair assumption, and it's been very well rewarded by the market for all those large cap holders of Bharti Airtel, Mahindra and Mahindra in particular. Look at the rally in SBI. It's breathtaking. So these stocks have given supernormal returns, and the banking space has also done phenomenally well. In fact, Bank Nifty is up 17%, 16.5% year to date. It's a phenomenal return given the kind of pain that we've seen in the broader market. A view on financials, Vaibhavji?
See, when we talk about financials, and here I'm not only talking about the banking, and I'm looking at financials from a financial services including your NBFCs, your asset management companies, your capital market companies, and insurance as well. Now, when we talk about the capital market driven companies, of course, they are cyclical in nature and the volatility will kind of keep about coming in, and it's directly linked to the sentiment from a market standpoint.
Correct.
But we do think that asset management companies and insurance companies on a longer term basis do provide a very good secular growth opportunity from a business standpoint. Of course, that needs to be married with the underlying valuations and the fundamentals, and a lot of research needs to be done from a bottom up perspective. But I think that's a segment on an overall basis looks pretty good from a long term. With respect to lastly, from an NBFCs, I think NBFCs have been the star movers for the last 1 year in that some sense. And I would say more so purely because we have seen the benefit of rate cards actually trickling in terms of their expansion of the margins and their profitability as well. But as we say, our view is that we should be close to the cutting of rates, probably one, and depending upon what RBI kind of says this week, our view is it's a time to kind of shift from NBFCs, which have moved pretty smartly. The valuations have kind of expanded to kind of the private banks universe where the valuation still looks pretty attractive. So NBFCs is something which we are currently avoiding. Asset management, insurance companies give a long-term opportunity, and private banks is something to be looked for as well.
Vaibhavji, what's the percentage of long short in your portfolio at the moment?
See, we are kind of generally we operate in a very strict band, okay, from a long and short perspective, purely because we do not take a very big directional call in that sense. Typically, you generally find my average net exposure over a very long period of time has been in the range of about say 10 to 15%. It is safe to assume that my net exposure currently is looking towards those kind of numbers only. It's neither higher than the average, not much of lower than the averages as well. It is only a little difference from my last 3 months where we were pretty low in terms of our net exposures, and that is where we've started to move our net exposure a little higher, probably because our view on the market is getting a little more constructive.
Okay, ballpark, you are net long.
Yes, we are net long.
Okay. Are you net long as a percentage higher than what you were 6 months ago?
Yes, we are net long a little higher than what we were in the last 6 months.
Okay. Are you higher net long in terms of percentage over September 2024? I think that would be a critical answer.
Yes. So September 24, I think it's a very interesting month, as you kind of rightly pointed, purely because at that point in time we were virtually net zero. So we didn't have a net exposure at that point in time. So of course, at this point in time, we are much better than that.
I think that's a very critical answer that you gave. When you say that you are more constructive in the market, how much of that positivity is because of a very strong macro tailwind, and how much of that positivity is because of modest green shoots in Q3 in particular?
See, I think it's a combination of all. There is no one single factor, to be very honest. If there is only one factor, then to be very honest, we wouldn't be constructive in that sense. I think the tailwinds from the policies, the measures which are being taken to revive consumption, the GDP growth, the earnings recovery, and the expectations that these reforms will continue to keep on kind of happening. Our sense is basically we've seen the bottom of the earnings, at least from a medium-term perspective. And as I mentioned, longer term, the markets follow the earnings. In the shorter term, it's euphoric or probably on the downside a bit, but longer term, on an average, it follows the earnings. And when the earnings are likely to recover, with valuations corrected from the top already, I think it's a fairly good place to be in Of course, the shorter term volatility is something needs to be kind of handled. But I think this is something which we are much constructive than what we have were been in the last 1 year.
Okay, fair point. Um, uh, how about this very sharp rise in Japanese 10-year yields, Vaibhavji? Does it have the potential to unravel the risk on trade globally? We've seen Bitcoin correct 32%. The bubble in the AI space has been pricked. It may not have fallen substantially. How are you seeing this yen carry trade phenomena?
Honestly, I think globe is full of variables which are absolutely moving, in their own direction, right? I mean, from as you rightly mentioned, Japan is seeing inflation and thereby the kind of bond prices, effect which we are seeing. At the same time, China is facing deflation, right? And they're fighting deflation in some sense. So it's a very interesting world where a lot of kind of signals are extremely dispersed, diverse in that sense. To make that sense out of it, it is very clear to understand that global investors will be looking for growth at the end of it. Now, if the growth comes about, whether it is from China, Korea, Taiwan, or from Japan or from US, I think they will continue to keep allocating money there. So AI opportunity, when we say that it is kind of pricked, of course there is always going to be some amount of checks in terms of the valuation at every kind of period of time. Now, whether can I say that AI opportunity as a business is topped out? I can, with some amount of conviction, say no, absolutely not. Purely because there is tremendous amount of development already slated to happen from an AI perspective, robotics perspective, and we do think that a lot of efficiencies will trickle down in terms of the businesses as well because of this opportunity. So my sense is I think this is going to continue. The investments are likely to continue there. It's just that what layer of AI opportunity is India going to kind of capture? If they are able to capture the second layer or a third tier or subsequent kind of opportunities, might as well you will see India getting allocation subsequently as well. So I am positive on the whole AI opportunity. Valuations definitely has to be looked at, but there would always be I would say green shoots or some hidden gems which one can probably look for as well.
Now, what are those hidden gems? You walked into this on your own.
No, I think from an India perspective, when we talk about, I think the network companies or the data center companies,
Yes.
I think that's a segment you should look at. In fact, all the IT services company in the immediate or the first leg of the AI, kind of progress, they have been at the receiving end, honestly. But I do think that as things kind of go ahead, you will see incremental business from AI kind of starting to flow in all these IT companies as well. So, which is why I said that we may not be the best kind of country or companies to capture the bigger opportunity like chips or other infrastructure from a hardware perspective, but from a software perspective, physical infrastructure perspective, I think there is a lot of things to be done.
Okay. My final question to you, Vaibhavji, is you are, of course, blessed because the structure of the fund is long short. So you can be net long, which you are based on the macro trend, and you can hedge that position with a lot of F&O products that are available. What are the chances that we might see this bull run getting derailed? Broadly, the market is already under a bear grip. If you look at the 30-40% correction that has happened in mid cap and small cap prices on quality mid caps. I'm not talking about SME at all. So what could derail this?
So I think very clearly, I think the moment we do think that the growth kind of starts to weaken, if there is any possibility, then I think that is a big derailment from a overall market performance perspective. Secondly, any big catastrophe from a global perspective, geopolitical perspective, which we currently I'm unable to envisage, but if something comes about there as well, there can be some amount of breaks kind of happening from a market performance as well. So of course there can be few things which can derail it, but as I do see at this point in time, larger number of variables are actually providing you a tailwind rather than a headwind.
On that cautiously optimistic note where tailwinds are better than headwinds, Vaibhavji, we'll call it a day. What a wonderful conversation with all sorts of asset classes and all sorts of options being discussed. Thank you so much for your time, and here's wishing you all the best for 2026 and all the best to you while navigating this volatile times. Thank you for your
Thank you very
time.
much. It's always great to be on your show.
That, ladies and gentlemen, was Mr. Vaibhav Sanghavi, CEO of ASK Hedge Solutions. Please continue to be with Business Trade Television. I'll be back with you at 3 p.m. for the last half an hour of trade as far as Tuesday is concerned.